Hey everyone, and welcome back to the channel. Today, we diving deep into a topic that's absolutely crucial whether you're looking to get a loan for a car, a mortgage for your dream home, or even a business loan to kickstart your entrepreneurial journey. We're talking about the 5 C's of credit. Now you might be thinking, what on earth are the 5 C's? Simply put, they are the 5 key factors that lenders use to evaluate a borrower's trustworthiness and decide whether to approve a loan. Think of it as the lender's report card for you. Understanding these 5 elements can dramatically increase your chances of getting that yes. So, grab a notepad, and let's break down exactly what lenders are looking for. The first and arguably the most important C is character. This isn't about whether you're a good person, but rather, it's about your financial reputation. Lenders want to see a history of responsibility and integrity. They'll look at your credit report, which tells the story of how you've handled debt in the past. Do you pay your bills on time? Have you ever defaulted on a loan or declared bankruptcy? They'll also consider your stability. How long have you lived at your current address? How long have you been at your current job? A stable history suggests you're a reliable and consistent individual, which is a huge green flag for any lender. Building a positive credit history by making timely payments is the #1 way to build strong financial character. Next up, we have the second C, capacity. This is all about your ability to repay the loan. Lenders need to be confident that you have enough income to handle your existing debts plus the new loan payment. They'll look at your income from all sources, your job, side hustles, investments, and compare it to your recurring debts. This is known as your debt-to-income ratio, or DTI. A low DTI means you have a healthy amount of income left over after paying your bills, indicating you have the capacity to take on more debt. Lenders will also look at your employment history and income stability. A steady job with a consistent paycheck is much more reassuring than sporadic or unpredictable income. So before you apply, it's a great idea to calculate your own DTI to see where you stand. The third C is capital. Capital refers to the personal investment you have in the potential loan. In simple terms, it's the money you're willing to put down yourself. For a mortgage, this is your down payment. For a business loan, it's the funds you've personally invested in your company. Why does this matter so much to lenders? Because having your own money on the line, having skin in the game, so to speak, shows that you're serious and committed. It reduces the lender's risk because if you were to default, they wouldn't lose the entire amount. A larger down payment or a significant personal investment demonstrates your financial health and your confidence in the purchase or venture, making you a much more attractive borrower. Lenders also look at your savings and other assets as a sign of your financial discipline. Now, let's talk about the fourth C, collateral. Collateral is an asset that you pledge to the lender to secure the loan. If you, for some reason, are unable to repay the loan, the lender has the right to seize that asset to recoup their losses. For a car loan, the car itself is the collateral. For a mortgage, it's the house. Not all loans require collateral. These are called unsecured loans, like most credit cards and personal loans. However, for larger loans, collateral provides a safety net for the lender, significantly reducing their risk. The value and quality of the collateral are, therefore, very important. If you're offering an asset as collateral, the lender will have it appraised to ensure its value is sufficient to cover the loan amount. Offering strong collateral can often help you secure a larger loan or a better interest rate. Finally, we arrive at the fifth C, conditions. This C refers to the external factors surrounding the loan. Lenders will consider the purpose of the loan. Are you using it to buy a reliable asset like a house, or for something more volatile like investing in the stock market? The purpose matters. They'll also look at the overall economic conditions. Is the economy stable and growing, or is it in a recession? During uncertain economic times, lenders tend to be more cautious and may tighten their lending standards. The terms of the loan itself, like the interest rate and the length of the repayment period, also fall under this category. Lenders want to ensure the conditions of the loan are appropriate for its purpose and the current economic climate. It's the one C you have the least control over, but being aware of it can help you time your loan application strategically. So to recap, we have character, your financial track record; capacity, your ability to repay; capital, your personal investment; collateral, the assets securing the loan; and conditions, the external environment. These 5 pillars work together to paint a complete picture of you as a borrower. Now you might wonder, Are all 5Cs equally important? Not necessarily. Their importance can vary depending on the lender and the type of loan. For an unsecured personal loan, your character and capacity will be the main focus. For a large mortgage, capital and collateral become much more significant. The key is that a strength in one area can sometimes help compensate for a weakness in another. For example, if you have a limited credit history, maybe a large down payment, strong capital can significantly help your case. Or if you don't have much collateral to offer for a business loan, but you have an impeccable credit history and a solid business plan that shows strong capacity, you might still get approved. Understanding the 5Cs empowers you. It takes the mystery out of the loan approval process and gives you a clear roadmap for what you need to work on. Before you even think about applying for credit, take a moment to assess yourself against these 5 criteria. Check your credit report to shore up your character. Calculate your debt-to-income ratio to understand your capacity. Start saving for a down payment to build your capital. Think about what assets you have that could serve as collateral, and pay attention to the economic conditions. By proactively managing these 5 areas, you're not just preparing for a loan application. You're building a foundation for long-term financial health and success. You retransforming yourself from a hopeful applicant into a highly qualified borrower that lenders are eager to work with. Thank you so much for watching today. I hope this breakdown of the 5Cs of credit has been helpful for you. If you found value in this video, please give it a thumbs up. It really helps the channel grow. And don't forget to hit that subscribe button and ring the notification bell so you won't miss any of our future content on mastering your finances. If you have any questions or want to share your own experiences with getting a loan, please drop a comment below. I love hearing from you all. Until next time, take care and stay financially savvy.